All right, welcome back. It's Mo, I got my little jingle wrong. Welcome back. It's another episode of the Tim and Tim Show every Tuesday at 10 a.m. Eastern Time. There it is. This week we're talking about the 5 biggest forces impacting real estate right now, but truth be told, it's always right. This is something that's ongoing. It's ever evolving, ever changing, and these are the things that Tim and I pay attention to on a micro and a macro scale all of the time in order to try to operate our deals as efficiently as possible and make money for ourselves and our investors. So we're going to talk about a couple different buckets of things here that that we pay attention to. First and foremost, interest rates and Fed policy. That's a super hot topic right now with the potential new Fed chair coming in May, 60 days from now. Insurance and operating expense inflation. We talk about this all the time. Lending tightness and credit committees. We faced some difficulties in the last couple of weeks with some lending tightness, and we'll talk about how that impacted those loans. Political noise. That's a big one right now with what's going on in Iran. So yet to be seen how it's going to really ultimately impact the real estate market, but we're going to openly discuss it. And then last but not least, investor psychology and capital deployment, right? Investors are the lifeblood of our company. If we didn't have investors in our deals, we wouldn't be able to fund them entirely ourselves. And the sentiment amongst investors is important to keep a thumb on, so you know how big of a deal you can go put under contract if you're going to be able to raise the money effectively or not. So that's a quick high-level summary of what we're going to talk about. But over to you, Tim. What do you think?
I think it sounds great.
Wonderful.
Cool. No, I mean, I think all those things are things we've been dealing with, right? And like you said, it's not just in this current market, right? I mean, those things in some way, shape, or form shape every market, right? It's just like, what are we seeing today in those buckets that are kind of influencing in what we're seeing in the market today? And it's, to me, every one of those things points towards why deal flow has slowed down over the last couple of years, right?
Transactional volume is down big time.
Yeah, and bucket number one that you mentioned, and maybe this is a good segue to start the discussion is, for me, one of the biggest reasons that things have slowed down from other people, not us. I mean, as long as it pencils, we tend to do stuff. Interest rates, right? People have been waiting for interest rates to drop. Which, to me is kind of looking at things with a very, very narrow focus. Like, yeah, I want interest rates to be lower too. But at the same time, if I find a deal that works at 7% interest, and that's what the rate is right now, I'll do the deal at 7%. And when it drops, we say that we're beating a dead horse, right? When it drops, it's just that much better of a deal, right?
Yep, correct. But you got to be in the deal first, because otherwise you're competing with everyone else to overpay.
Yep. Got to get in the deal first.
Did you watch? Shout out to Chris Yeagle. I know you watched these later on. Did you watch that episode from JP Conklin that I sent you?
Oh, no, I didn't.
You got to listen to it on our drive tomorrow, because I want to talk about it a little bit today. But ultimately, Chris Yeagle, many years ago, told me about this podcast. It's called The Rate Guy by JP Conklin. Him and his wife do it, and the banter in the beginning of the show is quite annoying, and I usually just kind of flip through that. But the meat and potatoes about what he talks about with the Fed interest rates, and he keeps a thumb on all that kind of stuff, is really, really good, insightful information. But he was talking about the new Fed chair. Oh, I can't. His name escapes me right now. The nominee by Trump, and basically what he was talking about was, everyone thinks that this guy coming into the Fed chair is going to be, what did you call it? Like a policy dove or something like that, where he's just going to do whatever Trump says. And that almost became a job requirement of any potential Fed chair that was campaigning to get that position. It was a job requirement to say, yeah, I want to lower rates. And he said, yeah, I want to lower rates as well. But JP Conklin goes into looking at the background of this guy, and he understands that he is more in the biggest things that impact rates right now are the jobs market, right? And people are paying attention to inflation and the jobs market. And the new guy is way more hawkish on interest rates rather than jobs. what that means is that he would rather have higher interest rates longer in order to sustain inflation and keep inflation as low as possible and reduce the Fed balance sheet as much as possible in spite of jobs. And he even goes as far as saying is he will keep the rates as high as possible as long as he needs to, even if the wheels fall off of the job market before he'll lower the rates, which I think is interesting because everyone is expecting that he's just going to come in and slash interest rates in order to kind of spur the jobs market because of all the jobs that have been lost. And I don't think that's true. I think rates are here to stay. I think we actually might see some increases by the end of this year. I don't know.
I, I don't, I gotta be honest. I didn't listen to the show.
Yeah. What is that dude's name? I gotta Google it.
I will, I'll sum it up. I'll sum my feelings up like this. Like, I hope you're right. Yet to be seen. Hope you're right. I think it would be against the
Evan
tide.
Warsh.
Yeah, I think it's against the tide of what we've seen from most people in the administration, right? I can't think of a single person in the administration that has gone against Trump to this point. So this would be a first. So excuse me if I'm a little skeptical and waiting for the first guy to step up and go against the big boss, right?
We'll see.
We'll see.
I mean,
and then the other thing, because the one thing I did do, because Tim and I talked about this, is I did look a little bit into, the guy's policy background is there, but he's got a lot of ties to Trump that those around him don't necessarily agree with his stances. So if you kind of look, and guys, I don't want to get into like the conspiracy theory stuff because I hate that shit. But there's a lot of reasons to think that maybe he is still getting the job in order to kind of do what Trump says. But we'll see. Again, hope you're right. Hope you're right, because I think as much as I want rates to come down, I think this is a really bad time for it. And we're going to talk about some other things in the show, but you mentioned one earlier, like what's going on in Iran right now, guys. Like that's not usually friendly to rates. So we'll see what happens.
which is interesting because the treasuries have dropped it over the last couple of days.
Yeah.
I don't quite understand how that happens. It's
I don't know either. And especially because, you start to look around and like we were starting to feel good about like gas prices and things like that, but gas prices are going to start inching up again. Because oil prices have shot up. Right. So I don't know, man, this is a strange market. It's all I know.
I'll go as far and say it's been a strange market since 2020 when COVID hit. I mean, it's like what's up is down and what's down is up. And what you would think the normal macro and microeconomics have impact, like are not even in play anymore. It's like you have a war, you would expect treasuries to go up, interest rates, the end user interest rates to go up. Generally the Fed cuts interest rates when they're trying to spur the economy in order to prevent a recession. But stock market's at all-time highs. And everyone's doing really well, but at the same time, they want to talk about cutting rates. And it's like, none of this makes sense anymore. I have no idea what's going on.
Yeah. Well, and it makes you wonder, like, how long can you sustain this, right? Like,
right.
And I guess some of this applies, right? Like, I know Tim and I are kind of getting off on a little bit of a tangent here, but the tangent still kind of applies here because we're talking about like insurance and operating expense inflation is exactly where this is going. Because, one of the conversations that we had a couple of weeks ago plays right into this. Like you're talking about, like, we're talking about oil prices, we're talking about rates being high, we're talking about this, that, and the other. And the stock market's doing great. But then you start to hear from like your employees and people who don't make six figures, and they're talking about like, I can't afford to buy groceries, right? So it's like the job market's good, but even the people that are working are struggling. And that's like so bring this back to property for a second. Like one of the things Tim and I have been going through right now, it's a lot of our leases are renewing right now, and we're going to our tenants and we're like, hey, we got to bump you up $50-$75, something like that. And the tenants are pushing back. They're like, I can't afford it. Like I can't I can't afford this, right? Like I can't even buy groceries right now. And, they're like, they're giving us this story and our property managers come back to us and I'm like, hey guys, like I hear you, but our expenses went up 7% 6 months ago, right? We've been waiting for this lease to renew at the $50 increase to cover the expenses we've been paying out of our own pockets for 7 months, right?
Right.
Like, so that's like one of the things we've been looking at is like, hey, with inflation, our expenses are increasing immediately, but our ability to offset that with rent increases is delayed. And
Yep.
so that's starting to eat into performance of the properties and stuff like that. So
Mhm.
like Tim's saying, like a lot of this just doesn't make sense to me. And you're right, man. This goes back to 2020. Like it goes way all the way back to 2020. Um,
Everything's been messed up since then, and,
but it,
you know go ahead.
Oh, I was just gonna say, but it's what's weird, Tim. Sorry, one last example is it was almost the opposite then, right? Like what I remember specifically one of the examples that we had in 2020. If you guys remember, like there was this like fast run up of salary, like hourly wages.
Oh, huge. Yeah. Payroll never
Yeah,
comes down.
yeah. So we went well, and where this impacted us was we had some affordable properties, some LIHTC deals that we literally could not lease because like February, March, and April, people's salaries started pumping up, right? But LIHTC properties don't allow for rent bumps until May, nor do the median income adjustments happen until May. So we had like this period of time where these guys got these raises, and all of a sudden the median incomes that could live on our properties for about a 3 month period exceeded what we were allowed to put in those units because
Mhm.
the rent bumps and the median incomes hadn't adjusted yet, but the market was adjusting real time. And it was like
Yeah.
skyrocketing during COVID. Those things were skyrocketing. And we literally couldn't I mean, the guy stocking shelves after hours at Target made too much money to live on our property.
Yeah.
Right.
And
And
a lot of that's
yeah,
because the information is done in arrears. Like
right,
the average median income and average median rent is done on a 12-month look back,
right,
right? So the rents that we're about to get updated for April 1, which this year have been delayed to May 1, they're looking back at what happened in 2025, but the
right,
market moves in real time. So,
right.
kind of put us in a bad spot, in a difficult spot on leasing residents. And at that point, you're more incentivized to leave residents in place
Yeah,
than, try to push the rent and acquire a new one. So
yeah,
it's just like what we said starting out. It's always something, whether it's
right.
there's always something, some kind of negative pressure impacting real estate in some way, shape, or form. Interest rates, insurance, operating expenses, utility usage rates, those doubled, in 2023,
Yeah,
2024 timeframe. The usage rates went up 50, 60%. Um, and that's never coming down, right? So, what you used to underwrite as like a $500 or $600 per unit per year water expense, water and
right.
sewer expense, is now like $750, $800 per unit, right? And all of it is a great point that you were saying is that we've already been paying out of pocket for 7 months these
Right.
increased insurance, tax, and utilities and payroll. And I'll say one of the ways that we've gotten our property managers on board with understanding, hey, we understand that things are difficult, but understanding from our perspective that we've been paying those expenses is we get them to review the income statement. And when they see how much money's coming in and going out the door, inclusive of our debt costs, it really puts into perspective why we make the decisions that we do and have the stances that we do. Because obviously, everyone's concerned, about, profitability of a company. They all understand, hey, if the company's not making money, I might not have a job.
Yeah.
And it's, you start looking at this year's financials versus last year's financials, and it's very clear and obvious to see where all the money's going.
Yeah. Yeah, and Tim, you mentioned the market. Like some of that just like it doesn't make sense to me right now. Like I mean, it hasn't made sense to me in quite a few years. Like I don't understand how the market's continuing to run the way it's running.
The
Especially
stock
when
market.
yeah, and
Yeah.
especially because when you like some of the things when you're talking about like on a basic principle level doesn't make sense to me. Like, hey, I know inflation's happening. I know costs to do business are going up. I know the cost to pay employees is going up. So, when when essentially you're doing the same amount of business, but your costs to do that business have increased. Like really the only lever you can pull is to reduce your labor force. But the job
Yeah.
market's been strong.
Yeah.
Like, so you haven't seen these like huge layoffs. You haven't seen this huge reduction in workforce. And so it's like, I'm not quite sure where it's all going right now. Like at what point does something kind of tumble and the whole thing starts to break a little bit?
Well, stock market's tumbling a little bit right now. I mean, it's kind of nice to see some red days here. Creates a buying opportunity sitting on some cash. So
Yeah.
just continue to watch here for the next week or two.
Yeah, and then I kick myself for not buying gold and silver like 4 years ago, right?
I know my buddy, you know him, Daniel Reddick sends me a screenshot like once a week of some silver thing that he bought on the stock market, and he's up like
Oh my God,
100% since the beginning of this year.
dude,
I
I
was
could
like,
I could have
oh,
retired.
all right. If you put it all on silver, not on black
Yeah,
or red, but silver.
yeah, man. Yeah, it's
Um,
it's been
yeah, but
interesting.
so obviously we're talking about insurance and operating expenses creating difficulties in your real estate deals. All of that kind of boils down to ultimately at the end of the day, your NOI and DSCR.
Mhm.
And what we've seen, I mean, we just completed a refinance 2 weeks ago,
Yeah,
and we're at like a 55, 56, 57% LTV or something like that. And it truly came down to cash flow, right? Well, because the cash flow is compressed right now, but property values and market values are still very high. It's very, very, very hard to cash flow right now with
yeah,
your payroll, your utilities, your operating expenses continuing to rise. But on a per door basis, when you do it like an appraisal on a comp based approach, the value is still there, right? So there's a ton of equity and very limited cash flow, which makes a lot of deals very difficult right now.
yeah, yeah. And I don't, just from a commercial real estate standpoint, and then even just like in traditional residential real estate, like you look around and I'm like, prices are still really, really high, like
Mm.
really high. Um, I don't I don't understand. I don't understand some of that, right? Like, Tim, you and I were talking with a broker late last week, early this week, yesterday. And they're one of the deals that I've been looking for a little while because I know the area really well. Like their pricing expectations come down like 16,000 a door, but they're still a good 30,000 a door over where they should be, right?
Mhm.
And they're like, oh, but if they can't sell it for that, they're just going to hold it for a while. It's like, oh, well, get prepared to hold because I can't understand paying that for that area. And to your point, I'm like, I don't even understand how that cash flows, but we're seeing that more, and we're still seeing that a lot, right? It's like, hey, I want this price, and it makes sense. And I got a BOV that says it makes sense. I got a bank appraisal for more than what I'm asking for. I'm like, yeah, but it doesn't cash flow. Like, I mean, I don't even think at 3% interest rate it would cash flow. Like,
Right,
so
right.
tell me how this makes sense. Um,
Yeah, but 10 years from now, you'd probably be like, damn, I wish I bought that place.
100%. That's and
You know,
that's
but it's got to make sense today.
Yeah. I mean, what was it? We were at that conference, right? And there was the one guy. I always forget where we were and who the guy was. And they were like, how'd you end up here? And he's like, well, I guess I just overpaid for all those properties 10 years ago,
Yeah, right. Right.
and
Yeah, it seems, counterintuitive when you're going through it and finding a good deal that works today to make
right,
money. That's that's the true talent, right? That's the complexity there is being able to find a deal in today's market, whether it's an up market or a down market that makes sense for you and your investors and your
yeah,
investment metrics today. And whatever it does in the future, it does in the future, right?
right.
I mean, if you think about people that were investing into Apple in the 80s and the 90s. I bet you it was very difficult to spend $1 a share or whatever it is. But look at it now. It's like, well,
Oh my
I'm
God.
sure glad I took that risk because I believed in the long-term potential.
Talk about shoulda, coulda, woulda, right?
Yeah, I know. If only I wasn't born in 90 and I would
If
have
if only
invested
I had
there.
listened to my buddy in '98 and bought Apple
Yeah.
stock when he told me to do it.
Was
Uh,
that after the bubble? Dot-com
oh
bubble?
yeah, Apple. That was right as Jobs was starting to come back, man. It was it was Jobs, as in Steve Jobs, was coming
Steve
back
Jobs,
to
yeah.
Apple. Yeah.
Yeah.
And it had seen its heyday in the 80s and early 90s and then just crashed.
Yeah. Um, yeah. So obviously, lending tightness makes deals difficult, influenced by operating expenses and interest rates and DSCR constraints. We've seen a lot of lenders now. They do a lot more stress testing on lower year amortizations. I think that's kind of a cop out to me. I cannot, for whatever reason, understand if you're giving me a loan
Ah,
on a
yeah,
25 or a 30-year amortization, why does it need to cash flow to 125 debt coverage ratio at a 20-year amortization? And they're like, well, we got to stress test it. Like, but the loan is not going to ever go up that much. So why don't you just increase your debt coverage ratio on your loan product instead of stress testing it down to this 20-year amortization or 25-year amortization that it doesn't even, that's not even applicable. I mean, I just can't, I really struggle with understanding and accepting why banks can do that or have the ability to do that, stress test it on a loan product that's not even the loan product you're applying for.
yeah.
Ah, ask me how I
I've
really feel about it, right?
Yeah, man. I can remember having that exact conversation. I was just trying to close on like a duplex, right? And they were like, "No, I'm gonna give you a 20-year AM." And like, why are you doing that? Because I'm worried about your cash flow. Then don't give me a 20-year AM.
Right.
I'm like,
Which makes the payment higher and reduces your
yeah,
cash flow.
yeah, give me a 30 if you're worried about my cash flow. Oh, well, there's too much risk on a 30. Huh?
Huh?
What?
Really don't make sense to me. I just can't understand the thought process. And somebody way smarter than me, like
Yeah,
people that own the banks, they understand, right? But my little pea brain can't seem to understand conceptually the common man's application of loan products.
yeah.
Whatever.
I remember going, I'm pretty good at math, but I'm struggling with that one.
Yeah, right. Yeah. Yeah. So how does political noise and political events, how do those impact real estate? Right now, it's kind of not really sure of how the war in Iran is going to impact real estate. We kind of talked about how we thought rates would generally go up if there's a war, but the treasuries are down right now. So back to this, I don't know what's up versus what's down anymore. So it's really hard to predict. But one of the things that we can talk about is how the government shutdown impacted our business and
Mm,
is currently impacting our business. We have a property
mm,
that um, we're trying to get refinanced after we did a big lease up, and we have a loan expiration that's coming up, and everything was hunky dory until about a month ago, maybe a little
yeah,
longer than that. Yeah,
yeah,
about a month ago when the housing authority said, we're all out of money. We can't approve any more new voucher move-ins at your property. And we
yeah,
had what, 8 in the queue to move in over the next like 30 days.
yeah,
And then they just pulled it and they just said, no, we can't fund those.
yeah,
So, that really put us in a bad spot because they were not able to get the funding from HUD, from the government, in order to fund these vouchers that they had made commitments to saying, hey, you're
yeah.
approved for a voucher. Go find a place to live. Oh, sorry, never mind. I'm going to take the voucher back. I can't pay it anymore.
Right. Yeah. They're only covering the vouchers that are currently deployed,
Currently
not the ones
deployed.
that
Yeah.
have been promised.
Yeah, yeah, and
Because
I had to explain that to the bank that we're trying to get a loan with is that it's no fault of our own or of the residents. Residents can't even do internal transfers. If they're in unit 1 and they want to move
right,
to unit 2, they can't do that because they would declassify or whatever that word is, make it so that they can't use that voucher anymore. They have to stay in place with a voucher that's in service today without moving it, which is it just makes
yeah,
complexity for us. And then not to mention when, the end of last year how long was the government shut down for, like a month or something? 6
something
weeks?
like that.
They weren't even, we didn't even get our voucher payments for, a month. And some of our properties are more than 50% vouchered, and more than 50% of our rent comes from subsidy payments.
Right.
So it can be really, really difficult when there's political unrest with, with playing with those kind of subsidy vouchers, playing with government housing funds and things like that.
Well, and then we were going through 2 or 3 refinances at the time as well. And
Yep.
One of them we were trying to go agency, two of them we were going agency, and we were getting delayed.
Oh, I
Like we
forgot.
just
Oh, geez, I've already put that in the back of my mind and
yeah,
tried to forget about it.
we were getting delayed, and people were like, yeah, but the agency lenders weren't shut down. Well, no, they weren't shut down, but they were some of the things they depended on, like the IRS, right? They agency lenders need certain government services to as part of their underwriting process. The agencies they were depending on to help them with their underwriting process to supply information that feeds their underwriting process were shut down. They could
Mhm.
not complete their underwriting process. If you can't underwrite a loan, you can't give a loan. So,
Right.
you so we were delayed on that. And then
Months,
at
many
this,
months.
yeah, and then not only and people are like, oh, it's a 6 week delay. No, it's a 6 week backup. And then when they come back towards the end of the year is typically a big time of the year for for loans and refinances. It was a huge backlog, huge backlog.
Especially when the treasuries were dropping as much as they were, and the Fed was
Yeah,
how many they cut rate multiple times last year,
yeah,
and then the treasuries built the futures and the treasuries, they predicted that, and it was all built
yeah,
into the rate, so you had a rush of people refinance. I mean, it was
yeah.
man,
There's that
2025. Whew.
that mental hurdle, right? That mental hurdle of like when rates drop below 6, I'm doing it, and rates drop below 6, especially at the agencies, right? And people
Mhm.
are like, I'm going. I want my 5 3/4 or 5.6, right?
Yeah,
Um, and so there was a rush on that too, right when the government was shut down.
yeah.
So
Yeah, geez, I forgot about that. That was
yeah,
painful.
yeah.
You just try to bury those painful
Um,
thoughts and forget about them. And then, last but not least, the one of the most crucial things that are impacting that will always impact your real estate
oh yeah,
business is investor psychology. Um, a lot of, I mean, gosh, I can't even tell you how many conversations I've had with limited partners in other deals that they lost all their money and they lost a
yeah,
significant portion of their money. I've had probably 3 conversations this year alone with other syndicators slash sponsors that either lost all of their investor money in they've had to close up shop, and one of them had been doing real estate for 10 years and now
yeah,
he's dusting off his W2 or sorry his resume to go get another W2 job.
yeah,
It's real right now. I mean, it's not hitting the headlines, but there's real money being lost in the commercial real estate
yeah,
space right now because it doesn't have to be disclosed publicly how much investor equity was put into a deal that you sold it for a loss and you didn't make any money on, right?
yeah,
It's
yeah,
very quiet right now because Main Street media, they're not reporting on it because it's not residential real estate that affects the everyday common person, right?
yeah,
With home values, and if you have a rental that that you used to live in that you converted to a rent, like that's a far more popular, far more common story to hear where people are losing money because they can't get loans on their properties and things like that.
yeah.
So we're finding LPs are being way more cautious.
Right.
And we've talked about this pretty extensively too. Is LPs have really learned what their risk tolerance actually is, which is significantly less than what was anticipated when it was when the real estate market was good. Oh, bring on the risk, baby.
Right.
And then when it flipped, it was no, 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 that's way too risky. And that's fine, right? It depends on what you're after and how you're willing to structure it and the level of return you're after. Like
Yeah.
if you got to remember where your position is in the capital stack dictates your level of return.
That's a really good way to put it. And Tim, I think there's, you're talking about those market pieces. I think that are playing. So I think you kind of got like a two part whammy coming, right? You got good operators who are doing the right things, who are being impacted by all these things that we're talking about. Therefore, LP returns aren't good, right?
Hmm.
And so LPs are, they're seeing that they're like, I'm not getting my distribution. There's you got to sell because you can't refi, and there's a 30% loss even though you've done everything you could. So LPs are experiencing that. And then the one thing that does hit the damn headlines, the one thing that does hit is the guys out there, the operators, the syndicators, whatever, who did shady stuff, right? So you even have that LP. It's like, I'm with these guys. They're doing a good job. They're really busting their ass. They're trying to do the right things. And then over here on the side, the one headline they do see is that crook that never had good intentions in the first place. They took a bunch of investor money. So they're like, I'm just staying away from this stuff. Right.
Mm-hmm.
I'm going to go put it in a mutual fund, you know?
Yeah,
Um,
I had commented on somebody's Facebook post about syndicator is already a dirty word. And when you
yeah.
see the headlines of a syndicator doing a $70 million Ponzi scheme, that just makes a dirty word even dirtier.
Yeah.
So it really comes back to like you really got to know the people that you're investing with
Yeah.
and understand their morals and and what they stand for. And not every deal is going to work out, right? But what are the good operators doing, and what is their decision making process, and how are they acting on those decisions when things are not good, when things are not easy?
Yeah.
The guy we're talking about, word on the street is he was a good guy, came into a little bit of hardship, tried to do something to save a deal. One thing led to another, and before you
Yeah.
know it, a couple years later, it's this big spiral out of control.
Yeah. Yeah. So, there's the guys out there who were bad from the start. There's some guys out there who were good that made bad decisions that spiraled and snowballed on them.
Hmm.
But those things all, they make the headlines, right? They're the few.
Yeah.
They are the things that make the headlines, and you combine that with the other stuff that's going on, and it's like, hey, guys, if you're out there and you're an investor listening to this, don't blame you. I don't blame you one bit. It's good to be cautious, and
Hmm.
I think there was a 3-4 year run there where people weren't, and hey, like Tim, I'll admit it. I got some guys who invested with me that over time, as the questions they're asking now that they're paying attention because of the current market trends and stuff like that, it's like an aha of like, hey, it sounds like you didn't fully understand the investment when you invested, and it's like, hey, good to know, right? So helps me understand what I need to do a better job of informing and telling people about. And it also does, you're having like real conversations with people and being like, until you fully understand this is probably is not something you want to do, right?
Hmm.
Um, and I think there was a long run there where that wasn't happening at all, right?
Yeah. Yeah. Yep. I mean, that's investor sentiment, at least in my experience for conversations that I've had, is that investors are less, their appetite is way less towards speculative value
Yeah,
add deals, right? And we've talked about that at numerous times now. And it's no secret that the way that we're underwriting today is what's my in-place rent roll, what's my in-place cash flow, right? And steering the direction of the conversation towards how does the property cash flow today, and how are we going to increase the cash flow over time, rather than try to do it quickly and refinance out in order to create this big equity pop, right? Now, I'm not saying, I'll say it again. It's not that that's not a valuable business plan that you can still execute on a business plan like that, but the deal really has to make sense for us to be able to do that and take on the risk of short term debt, but then also, the higher interest rate. Because, I was having a conversation with a newer investor about a deal in a market that we own in that they wanted to partner with us on. And the conversation was that, I'd rather get a loan that we don't have to refinance in 2 years, not only because of the refinance pressure, but also
right,
because of the lost equity through the refinance transaction. You're paying point on the exit, point to the lending broker, closing costs, attorney fees. I mean, depending on the size of the deal, could be hundreds of thousands of dollars. And that's all just lost equity
lost
because you had to
equity.
refinance, and
Yep,
it's in, you position the property and the deal into a better position to cash flow and make some money for the investors. But I think that puts you back more than
right.
it puts you forward. And it's really kind of changed our output of what we're looking for and how we're structuring and offering to make our deals. So,
Yeah, agree. Hey, real quick before we go,
yeah.
take this back to the beginning. Uh, Apple stock closed on December 31st, 1998 at 31 cents a share. And
Oh
it
my
was,
gosh.
and Tim, it was up 200% on the year at that point.
Oh my, 31 cents. Oh, and then it's
Yeah.
split like what, four times? And now it's like 200 something dollars a share. Oh my goodness gracious.
So guys, go out there, do the
Woo.
math. Like if I would have invested $1,000 in Apple stock on December 31st, 1998, what would it be worth today?
Oh my gosh. So, all right. Well, thanks for bringing that full circle. And now I really feel bad about not investing when I was 8 years old.
All right, guys. Have a good
All right.
week.
See y'all later. Peace.
Peace.